My name is Andrew Bailey. I teach philosophy, politics, and economics at Yale-NUS College in Singapore, and I do research on Bitcoin with the Resistance Money Research Collective. You can find our work online at resistance.money. Here are the other boys in the band, Brad Rettler and Craig Wormke. You should follow them both on Twitter. Our goal is to understand and evaluate Bitcoin, to understand and to see what this thing is doing to our world, and then to evaluate it, to figure out whether that's good or bad or something else besides. Here's what's going to happen in this talk. I'll first say a bit about the genre and approach we'll take. I'll introduce my main question, which is how Bitcoin's market price relates to its protocol and that protocol's ultimate ambitions. I'll give an answer, which in 3 words is bootstrapping through speculation. And I'll draw out the consequences that follow. The basic story here is that Bitcoin is an alchemical experiment, whereby one thing is transmuted into another. The input here is speculative greed, and the output is cypherpunk technology deployed at scale. We'll see more what that means shortly. My genre and approach can be understood by first noticing that Bitcoin is a bundled phenomenon. This isn't just a piece of software. It's something that spans cryptography and computer science and social and political theory and economics and more besides. To understand Bitcoin, you've got to pull from all of these fields and more. That sounds like a tough order. And it is. One must here be willing to hop fences. But there's a danger when you hop fences. Epistemic trespassing, a great little phrase from the philosopher Nathan Ballantyne. This epistemic trespassing happens when you veer beyond your own expertise and stray into someone else's field and start talking crap. Start saying things when you have no idea what you're talking about. This is a real danger, and even more so when we're pursuing mixed questions that blend or hybridize thoughts from different disciplines. But that's something we must do to understand Bitcoin. Another danger that I'll be less concerned with is border policing. People saying, how is this philosophy? Or, where's the computer science? Or where's the economics here? Or, why are you talking about Bitcoin? Isn't that some sort of silly internet thing? I draw inspiration here from the philosopher Christy Dotson. My approach is to not care about the genre of my research. Instead, it's just to try to say something that's interesting, that's plausible, and that's useful. If I can do that, I'll have succeeded. Even my philosopher friends will not recognize whatever it is they see here. I'm a bit more worried about this problem of epistemic trespassing, though, and so I want to initially propose the strategies, or one key strategy we can use to ward off that danger. And in 2 words, this is intellectual arbitrage. There are idea markets, disciplines and clusters of disciplines. And in these idea markets, some ideas are in very full supply. Everyone in a given discipline knows these little things. Maybe you learn it in your first year, in your Econs 101 class or Philosophy 101. Those ideas may be utterly unknown or unfamiliar to folks in other fields, though. They're in short supply and precious indeed elsewhere. So here's what you should do. You should export. Take an idea that is well understood, maybe even just from a textbook in one field, and bring it to another and see if you can apply it to some new phenomenon. And here's why this protects us against epistemic trespassing. We're not working with the fringes. We're not trying to take something on the cutting edge and that's very fancy and that requires a PhD to understand. We're taking something from the body of one field and applying it to another. And it's much easier to do that in a responsible way. Here's some of the idea markets that I'll plunder in this talk and export from one to another. Computer science, cryptonomics, social theory, metaphysics, political philosophy, philosophy of technology, and more. And if you look at my other published work with my colleagues, you'll see a bit more about how we think about how to do this, in the Bitcoin case in particular. That said, my approach throughout will be exploratory and sometimes speculative, as is fitting to the topic. The probability of the stuff I'll say, conditional on what is known, will throughout be less than 1. But I hope it'll be higher than 0.5. Some Bitcoin basics. Turn with me to 1993. The cypherpunks emerge. A group that had this ambition and this fear. Let's start with the fear. They saw the internet coming, and they worried that it would turn computers into engines of oppression, of surveillance, of control. Turn to their ambition. They wanted to use cryptography to stave off this possible dystopian future and to turn network computers into engines of freedom rather than oppression. They wanted to empower individuals with cryptography. Now, over the 20 years that followed, a conundrum appeared. How do we get people to actually use freedom technology? Now, I mark the beginning of the cypherpunk era with Eric Hughes's classic piece, A Cypherpunk's Manifesto. And I've learned a lot about the subsequent things that followed from another great talk by Eric Hughes in 2012. I recommend it, and I will be drawing from it elsewhere in this talk. This conundrum is often a bootstrapping problem. When the goods in question, when the technology in question involves networks, what we see here is a problem of initial social coordination. How do you get people to use something in the first place? We'll say more about that problem shortly. That was 1993. Turn to 2008. Enter Bitcoin. Satoshi Nakamoto dropped on the world a bomb. 9 beautiful pages. 1 lovely white paper. And here's what it gave us. First, a network. Bitcoin, capital B, is a distributed peer-to-peer network defined by a certain protocol and attached to a certain ledger. And there are 3 kinds of participants in this network, mutually overlapping in some cases. There are users who broadcast transactions, sending amounts of Bitcoin from one address to another. There are nodes that validate transactions and maintain copies of the ledger. The network is distributed in that way. There are finally miners who compete with one another to publish updates to the ledger. These updates are known as blocks, and the blocks are related to each other in a certain cryptographic way. Each block contains a hash of the previous one, creating a tamper-proof, or rather tamper-resistant, chain of blocks known as the blockchain. Now, miners have to give something up. They make a sacrifice. To publish a block, they have to throw a bunch of processor cycles and electricity, and they get a reward for doing this. New amounts of the network's native asset, Bitcoin, capital B, or BTC. BTC, as I think of things, is an abstract synthetic commodity. Abstract. This stuff is not physical. Look around and you'll never find it in meat space. Nor will you find it in a periodic table of the elements. It's synthetic. You won't find this in nature because we made it up. It is still quite real, though. Obviously, we make up lots of things. And it's a commodity. It's divisible, in the best cases, fungible, and so on. I draw here from the monetary economist George Selgin and my colleague Craig Warmke. Here's an analogy I found helpful. I heard this on a podcast. BTC is to electricity as aluminum is to electricity and bauxite. So the inputs to get BTC are you take hardware, ASICs, processor cycles, and through mining, you run some current into that hardware, out pops BTC. Well, how do you make pure aluminum? Well, you take some bauxite, you run some current through it, smelting, and out comes aluminum. Now, in contrast to aluminum and other natural commodities, BTC is innately standardized. Gold doesn't come to us prepackaged in 1-ounce quantities. Bitcoin does. We call those innate quantities Satoshis. There are 100 million Satoshis in each Bitcoin, and at steady state, there will be just shy of 21 million Bitcoins. Now, this asset has this interesting property. If you control the private keys to UTXO that encodes some Bitcoin, you can use the network in a very interesting way. You can send a certain kind of message on the network. We call those messages transactions because they unlock a UTXO over here and then slide it over into another address over there. You can learn more about the metaphysics of this from my colleague Craig Warmke's forthcoming manuscript, Electronic Coins. Put the network and the asset together. What do we have? I see a base settlement layer without trusted intermediaries that's censorship resistant and that facilitates privacy and pseudonymity. It's a cypherpunk dream come true. One can see this, by the way, even without being a libertarian. You don't have to be committed to some ideological, propertarian, or libertarian view. The way to see that this is a dream and not a nightmare is just to have some minimal anti-authoritarian commitments. If you're in that zone, you can see this as contributing something interesting and maybe even very, very good to the world. There's an elephant in the room already. But wait, you say, this is not why news outlets report in Bitcoin. It's got nothing to do with what they say. What do they talk about? One thing and one thing only. Price, price, price. It's up, it's down, it's sideways. Where's it going to next? Everyone wants to talk about the Bitcoin price. And so I will too. Here's my main question. I want to know how these three things relate. The Bitcoin's price, protocol, and purpose. Let's focus on price. This, of course, is the price of the asset, BTC. A Bitcoin price reports what market participants are willing to give up to have that peculiar network privilege to be able to send a certain kind of message in the network, a transaction. And this thing blows around like the wind. Highly volatile. Nonetheless, there's a decade-long story we can tell here already, which is of a new asset class monetizing, of course, with considerable bumps along the way. First past that story, you look at the Bitcoin price in US dollars plotted against time, this is the last decade, and you see, on a linear scale, some pretty spectacular peaks and valleys. Switch to a log scale and you start to see the other side of the story, which is that there is a definite trend here. This is the story of a new class of assets monetizing. That doesn't happen every day. The other things we're asking about are the protocol and the purpose. We've already said a bit about those. The thing I want to focus on, the element of the protocol that I find interesting here, is the supply schedule. So we'll say more about that shortly. But we can already more sharply state our target questions. The first is, well, how does Bitcoin's protocol, in particular its supply schedule, bear on the market price of its native asset? The second question is, and how does that price, in turn, bear on Bitcoin's capacity to make good on those cypherpunk dreams? Here's why the questions before us matter. Networks, whether social, like Facebook, monetary, like Bitcoin, or gaming, like World of Warcraft, these things are all the rage. It would be very nice to be able to think clearly about how to evaluate them. That's one thing we'll do today. Bitcoin, too, is all the rage. In the midst of speculative frenzy, it would be nice to know if there's any there. It would also be nice to know whether Bitcoin has actually managed to resolve the cypherpunk bootstrapping conundrum, and if so, how, and at what cost, and whether it can be done again. I'll say more about this bootstrapping problem. The question, recall, is how do we get people to actually use freedom technology? This is a problem of social coordination. Even when the optimal outcome is that everyone uses, let's say, Tor or PGP or Bitcoin, viable paths to that optimal outcome may make the relevant agents worse off along the way because of switching costs or inconvenience, loss of data, loss of value, reputational risk, and so on. Now, this problem is hard enough. It's even harder when it comes to network goods. A network good is a good that you get more utility out of when others are consuming it alongside you. The more the merrier. Now, the problem here is that you won't fully enjoy the good until others have joined you in your party. That means that to fully enjoy the good, you need social coordination and cooperation. You need to convince other people to do something before you can do it. You cannot go it alone. So it's bad, this bootstrapping problem. It's worse for network goods, and it's even worse for distributed networks because there's no one central party to pay people to participate, say. And worst of all, this bootstrapping problem arises for monetary networks because people are very reluctant to accept funny money, this new money that you invented. To see this clearly, just imagine you've invented a new language. It's a kind of network, or a way of encrypting computer network traffic, or you've invented new money. So here's you. How do you convince the next fellow over to accept your new language or your new money? That's hard enough. Now, once the two of you are doing this, maybe you can convince a third to join, and others. But those early nodes are tough. The bootstrapping problem is a real problem. A case study is useful, so turn to David CHAUM'S DIGICASH, a fascinating project and a precursor to Bitcoin, one of many, all of which failed. Why did DIGICASH fail? Well, the answer isn't that complicated. People didn't want it. Despite millions of dollars to pay for the development and the promotion of DIGICASH, it was very hard to persuade banks and merchants to adopt it, and users didn't want it either. So what David CHAUM learned is that if you build it, they probably won't come. Now there's some tricks that one might use to bootstrap a network. I do not claim that these didn't work for Bitcoin, but they had only limited effects. You might think that there's non-exchange value here. Gold, for example, is shiny and conducts electricity well and can be beaten easily into jewelry. Bitcoin, I'm afraid, doesn't have any of those properties. That won't help. Bitcoin has only limited use as a collectible because in 2009, very few would see owning BTC as a serious status symbol, and its niftiness factor would be recognized only by a few nerds. Now, some networks bootstrap by having a centrally distributed and antecedently valuable enticement to participate. Money, let's say. Real money, let's say. As when Blizzard pays you to play a beta version of World of Warcraft. That's them bootstrapping their network in a centralized way. There's, of course, no one to do this for Bitcoin. Ideology is another way to bootstrap. When you convince people as a matter of religious zeal or cultish fervor or political commitment that they must have and use this new asset. But there just aren't enough of those people around, and there are other risks attached to that strategy. Finally, one could use the ransomware route. Here, you force people to have liabilities denominated in BTC. So they have to pay you in BTC, so they have to acquire some BTC. It creates artificial demand for BTC, much in the way that taxes in a given sovereign currency create artificial demand for that sovereign currency. But this is illegal and wrong, and there are limits to this as a bootstrapping strategy. So what we see here is a cluster of tricks that are not useless, but they're simply limited. What we see in the history of digital cash projects, private digital cash projects, is that they grow perhaps to a point, but not much beyond that. They're stuck in these little bubbles. What's needed is a more potent bootstrapping strategy. Interestingly, perhaps the most potent one that Satoshi could have used, well, not the most potent, but a potent one he could have used, which is ideological bootstrapping, is one that he rejected. So some suggested marketing Bitcoin as a currency outside the reach of any government. And Satoshi, in his usual restrained way, said, I'm not making any such taunt or assertion. I said that I'd talk about the protocol and its supply in particular. And there are three factors that one might consider here. There's the difficulty adjustment, the periodic halving, and the supply cap. And together these conspire to create an ultimately fixed supply schedule. I'm going to focus on the difficulty adjustment. Bitcoin is a very unusual commodity compared to aluminum. When aluminum prices rise, more of it gets smelted. When prices go down, less. When BTC price rises, miners do indeed mine more of it. And when it falls, they mine less, for a time. But every 216 blocks, that's every 2 weeks, the protocol adjusts the proof of work target. The lower the target, the more work is required to make new Bitcoins and add a new block to the blockchain. There are more zeros in front of the SHA-256 hash required to successfully post a new block. And if you haven't gone below that target, or if you hadn't hit at or below that target, nodes will reject your proposed block. Here's the consequence of this very peculiar design feature. No matter how frantic or lazy Bitcoin miners are, blocks will continue to arrive on average every 10 minutes. Try as they might, miners will not, for any real length of time, past 2 weeks roughly, create blocks faster or slower than that. Here's Bitcoin difficulty over time. It mostly goes up. Turn now to some basic economics. Standard neoclassical price theory teaches us this. A commodity's equilibrium market price lies where its supply and demand curves intersect, where we chart these curves on price against quantity. Demand curves slope down, that is, the more expensive something is, the less people want it. Supply curves, by contrast, slope up. The higher the price is for something, the more people are willing to produce it or supply it to the market. Now, Bitcoin's supply is unusually and irremediably inelastic. Its supply curve is close to a vertical line. It does not respond to price in the way that traditional commodities do. And to see that clearly, just think about the difficulty adjustment. The variables that control the difficulty of mining Bitcoin are endogenous to the network. The network does not look out at the price of Bitcoin on some exchange, for example, and then adjust supply accordingly. No, the supply is adjusted based on how fast blocks are coming in. That's it. Let's visualize this. We put a demand curve, slopes down, a supply curve, slopes up. Where they meet is the market equilibrium price. So this is an ordinary commodity, let's say, with a fairly ordinary supply and demand curve. Let's say that people wanted this thing more. The way we model that is we push the demand curve to the right. So a greater quantity is demanded at a given price. Well, the new equilibrium market price is where the two curves intersect, the pink and the blue. In this case, would be $2. As demand went up, it pushed the price up. Watch that supply curve. That's the one for an ordinary commodity, and this is the one for Bitcoin. Something closer to a vertical line. So let's say we have our demand as it is, the equilibrium price is $1, and the quantity demanded is 1. So far, so good. But let's say the supply went up. So we push that demand curve to the right. What is the new market equilibrium price? This is the same increase in demand as we were thinking about before. It is not $2 as it was before. The new price is $2.50. Bitcoin is rocket corn. And notice what's true of the upside is true of the down as well. This shift in demand for an ordinary commodity would have increased the price only by $1. Here, it increased it by $1.50. It's true on the downside as well. Similarly, a drop in demand would create disproportionate drop to the Bitcoin price. Now, the point I'm making here is somewhat familiar, but I'm focusing on the difficulty adjustment rather than supply cap. Of course, the inelastic supply is a consequence of the protocol's supply schedule in totality. All three of those factors together work to make this thing inelastic in its supply. But it's the difficulty adjustment and not the supply cap that plays a controlling role here. And to see that, you can just consider the counterfactual where there's a clone of Bitcoin that has a supply cap, but no difficulty adjustment. Think about how miners would respond to changes in price. They would speed up or slow down their mining, and you would see some elasticity in the price. More or fewer Bitcoins would be created. Blocks would come faster or slower depending on the price. Of course, the party would all end when reaching the supply cap. But the thing to see there is that the active variable here is more closely the difficulty adjustment rather than the supply cap. A subtle point, often missed, but I think important. Here's the consequence of all of this. Bitcoin's market price, as a result of the design of the protocol, is unusually and irremediably sensitive to fluctuations in demand. This is at least what the theory would predict. And in fact, the theory is validated by the empirical facts. BTC is volatile in its price. And what's true of the upside is true of the down. Mania, or bubble talk, and despair, or death talk. My colleague Craig has summed this up very nicely in a meme. It's a bubble, it's dead. It's a bubble, it's dead. It's a bubble, it's dead, and so on. Look again at the linear price chart. You see peaks and valleys, lots of them. We can get a slightly more fine-grained measure by considering 30-day volatility, that's green, and 180-day volatility, that's red. Now some will squint at this chart and say, but volatility in these 10 years is trending a little bit down, and you can see that. But notice that in the midst of those 10 years, the asset has seen a dramatic rise in value, roughly from 0 to $1 trillion market cap. Given that spectacular aggregate rise of the asset, I think these, volatility is going down, people should be disappointed by the actual facts here. This thing remains a volatile beast. It blows around all over the place. Now there's some econometric disputes here about how to best measure volatility. I'm not going to step into those at the moment, but I recommend a blog post by J.P. Koning if you want a brief, non-technical introduction. I've said that BTC is volatile. True. That can sound bad, but let me be clear. BTC is a great asset to trade if you're a speculator, because speculators thrive on volatility. And notice that speculators also provide liquidity. They provide an order book that's full of offers to buy and sell. So when you want to enter or exit the market, you can. And liquidity, as it turns out, attracts liquidity. And the result here is an asset that monetizes over time and the network's reach expands. We'll see more later about what that actually means. Speculation can, in this case, has overcome powerful incumbent network effects. Here's what's happening. Here's what's happened. Despite speculative booms and busts, Bitcoin has bested the bubble naysayers at least 3 times, in at least 3 ways. At least 3 times, people have declared Bitcoin a bubble, and then when the bubble bursts, they've declared it dead. And 3 times Bitcoin has proved them wrong. First, there have been recoveries from spectacular crashes. There have been new highs, 10x, 50x, 3x, at least, from previous highs. And endogenous network fundamentals trend always towards steady growth. So 1 bubble, well, that's just a bubble, but 3 with higher lows and ever higher highs. This isn't a bubble. This is adoption. The way to see this, once again, is to look at the log chart. Bitcoin is becoming a serious asset class. It's monetized. Here comes the alchemy. Here's the claim I'm going to argue for. Monetized Bitcoin, something that's happened through its volatility and speculative attraction, is freedom technology at scale. I'll say what that means shortly. But note first a key distinction. There is Bitcoin's famous NGU technology, number go up. I think we should distinguish between 2 aspects of NGU technology. There's the claim that number will go up. That's future-looking and not what I'm going to do here. There's another claim, though, which is responsible to make. And this is that number already go up. I'm going to look not at what might happen and not what it will happen, but what it has happened. I say that what we see when we look at what has happened is freedom technology at scale. Now there's a tempting thought initially you might have here, which is that monetization through speculation is at war with these cypherpunk ambitions. It's basically greed versus freedom. I'm going to argue that this thought is fallacious. Here's a key factor to notice as we start to look at what has happened to Bitcoin as it has arrived as an asset class at scale, which is scaling through economic density. And I've learned here from Nick Carter's work. The key ratio to look at here is value settled per byte. So we have a certain number of bytes on the block and a certain number per transaction, let's say 250, 300 bytes per transaction. You could look at, well, how many Bitcoins are spent? How many inputs and outputs are there for that transaction? I say do that, yes, but also consider how much, let's say in US dollars, value is being settled per byte. As number go up, and remember this is looking backwards, number has gone up. Here's what's happened. We see increased economic density. More US dollar value is being settled per byte. What are the consequences of this? Well, think of privacy and pseudonymity. The network can now handle higher value transactions without revelation, a kind of privacy through obscurity. So consider this scenario. Market cap of Bitcoin is $1 million. You want to secretly send $1 million. How do you do it? Well, not with Bitcoin. You could not hide $1 million transaction with $1 million market cap. But with $1 trillion market cap, you can. That's just a couple of Bitcoins. Why not? And notice that in highly private transactions, those that use specialized privacy-enhancing techniques, like CoinJoin, even when the number of those transactions isn't going up, then the amount of value settled in private transactions is. And this, in fact, is happening. So here we see that through economic density, scaling of cypherpunk technology is actually happening. It's more available and more effective. The same is true of censorship resistance. A healthy swarm of nodes, lots of different people validating the Bitcoin network and obsessively checking to make sure every transaction that their node sees is valid by the rules that they choose. This makes for a resilient network and one that's very expensive to censor. You can see bitcoinnodes.io for a great visualization of discoverable nodes. And of course, there are many, many more that are not so easily discoverable. Increasingly, users don't need to touch fiat currencies at all. You can live a Bitcoin lifestyle. And so it turns out that banning Bitcoin, though it may once have been possible, simply isn't anymore. This is a quixotic thing to try. Governments and other large-scale actors simply can't do it. It's too expensive. Here's another dimension to consider. Development. Developers, as it were. A valuable network with a valuable native asset, of course, attracts people to work on that network. And if we look at GitHub activity on the relevant repos, what do we see? We see very healthy developer activity across the board, mining and nodes and wallets and so on. So there's a kind of infrastructure that monetization at scale attracts. There's also exogenous infrastructure. This is on-ramps and off-ramps for the rest of us. Those of us who aren't willing to wire money to Mt. Gox, let's say, but who will set up a Coinbase account. This makes possible monetary sovereignty and saving technology for the least well-off among us, and for great introduction to what this can actually do, see my colleague Bradley Rutler's essay. And citations for all of these are at the end of the talk, by the way. I've listed a number of dimensions and shown how freedom technology is actually being scaled up because the network has scaled up in value. And notice that all of these factors are reflexive. They build on each other. So for example, attention, which happens when number goes up, this spurs developer attention. Techies start to work on the project, and that in turn creates new privacy techniques. So for example, a wabi-sabi. Monetized Bitcoin is freedom technology at scale. That's been my claim. Now here's a caveat we should consider. Miner fees are denominated in Bitcoin. When number go up, the dollar cost of using the Bitcoin network goes up too, because you got to pay. Do these higher miner fees price out non-speculators and impede freedom uses of the network, as we might call them? Not obviously. Here's a somewhat hopeful but somewhat realistic hypothesis. High fees, in fact, drive users to Lightning and other L2 solutions. Here's the lesson I draw from all of this. Bitcoin's here. It's a $1 trillion asset class. Number went up. And when we look at the effects of this, we see this important truth. Monetization through speculation is not at war with cypherpunk ambitions. The two have worked together in a very weird and very cool way. There's this driving force, speculative greed, and it actually turns out to be irrelevant. You might have thought that these two things are in conflict, but they are not. And I learned a lot on this point from Alex Gladstein, who's got this great slogan. Alex is the Chief Strategy Officer at the Human Rights Foundation, and a couple of years ago he discovered Bitcoin and saw its potential for humanitarian purposes, and ever since has been one of Bitcoin's most interesting and loud and persuasive proponents. And here's this slogan Alex came up with, which is memorable and useful, and, as I've argued, nothing less than the sober truth, which is that Bitcoin is a machine that turns greed into freedom. It's amazing. Now here's an interesting side question. Is this all by design? Now strictly speaking, this is irrelevant, but it is intriguing, isn't it? Here's a little bit of moon math from Hal Finney. Many will have already seen this. Don't take this too seriously, but it is Hal. So pay attention at least a little bit. And here's something interesting Satoshi had to say in reply. It might make sense to get some, just in case it catches on. If enough people think the same way, it becomes a self-fulfilling prophecy. Once it gets bootstrapped, there are so many applications. This little line from Satoshi, again, understated and restrained, as everything he ever said always was, gives us a clue. I think he knew that the way to bootstrap Bitcoin was through greed. Speculation would be Bitcoin's path to full monetization. So I've arrived now at a working hypothesis that has some evidence for it. Bitcoin succeeded where other cypherpunk projects failed, and in particular it harnessed speculative greed to overcome powerful incumbent network effects to solve the bootstrapping problem. I've described this as a kind of alchemy, and I want to say a bit more about the mechanism of alchemical transmutation here, and contrast it with those we see deployed by other successful networks that have solved bootstrapping problems. And it'll be useful to distinguish between positive and negative liberties. And here I'm drawing from, of course, a classic essay by the political theorist Isaiah Berlin, and I drew the connection here thanks to Eric Hughes' 2012 talk. Here's the distinction. Positive liberties, on the one hand, these are ordinary abilities and the opportunities to exercise them, to walk, to eat, and so on. These are very good, and we like them. Negative liberties, by contrast, are enjoyed in the absence of external constraints. You have negative liberty when censorship is absent, for example, or when domination of a certain kind is absent, or when surveillance is absent. When something isn't there, you enjoy negative liberty. Now, of course, this is a vexed distinction, and it's not always easy to separate these two, but it's extremely useful nonetheless. Here's my hypothesis. People, by and large, want positive liberties. True. They also want them more than they want negative liberties. Not everybody is a raging libertarian. Not everybody will say with Patrick Henry, "Give me liberty or give me death." That said, we still need negative liberties to flourish. So there's my hypothesis about human nature. And here's an observation. The cypherpunk dream, alas, is all about negative liberties through technology. It's all about absence of censorship, freedom from surveillance, and so on. Now, if this hypothesis and observation are correct, there's actually little sense in offering freedom technology, negative liberty, alone, as the old cypherpunks tried. People just won't want it, or at least they won't want it enough. They won't be willing to give up anything of value for it. And the problem is compounded when the technology in question involves network goods, because network goods have built-in bootstrapping problems, because you got to convince other people to use it before it's useful for yourself, or at least before it's maximally useful. But what if? What if? What if you got paid to solve a bootstrapping problem? What if you were reimbursed for pursuing negative liberty, both for yourself and for others? Well, I think you would see the value of it then, wouldn't you? We all wants to get paid. So whether by design or not, this is what Bitcoin has done for its early adopters. They got a bunch of positive liberty, and in return, they monetized an asset and gave negative liberty to the world. Look at the model here in the abstract. The achievement of negative liberty through monetary enticements, which you can think of as facilitating positive liberty. Interestingly, the model in view is the precise opposite of what's deployed by other networks when they bootstrap. Look at Facebook, for example. Facebook offers you certain positive liberties, but you must give something up to enjoy them. You must give up your own negative liberties. You must endure a little censorship, a little domination, a little corporate surveillance, and in exchange, an avalanche of positive liberties will fall upon your head. This is not the Bitcoin way. The Bitcoin way is to pay you to be free. Here's an open question then. Bitcoin's strategy seems to work. Is it repeatable? Is it being repeated? Something to think about. My arguments thus far, alas, do have a few limits. Or at least, questions. Here's the question of ongoing fungibility. One aspect of Bitcoin's spectacular rise is the rise of regulated and custodial BTC products. Think here of BlockFi or Robinhood or PayPal. And Robinhood and PayPal in particular are worrisome here because you can't take your Bitcoin out of them. You don't really own the Bitcoin. Not your keys, not your coin, as they say. These are walled gardens. They create financialized replicas of Bitcoin. And of course, PayPal does own the Bitcoin and Robinhood does own the Bitcoin, but you don't get to touch it and you can't take it on chain yourself. So here's the question. Do these regulated walled gardens, will they grow? And will this facilitate a two Bitcoin world? Two sides of the wall, mutually non-fungible, where you can't actually import or export from the walled garden to the free Bitcoin that runs on the Bitcoin network itself, an open network? I don't think answers to these questions are obvious, and those who'd say yes to either question, well, they have yet to make a convincing case, but it's something well worth thinking about. Other limits to my main argument may stem by thinking beyond Bitcoin and thinking how this relates to other crypto assets. I simply flag that as a limit that I will not speak to today. We've looked back. Let's look ahead. Significant progress has been made in solving a bootstrapping problem that has plagued other cypherpunk efforts and digital cash projects in particular. This is an impressive feat. Well done, Satoshi. Well done, speculators. But I think a transition problem has been thereby created by the very same mechanism that BTC used to solve the bootstrapping problem, which is volatility and the speculation that it attracts. Now, this volatility is predicted by price theory, it's borne out in practice, and it is, I would guess, with us for the foreseeable future. The point I'm making here is not this old canard, oh, Bitcoin is too volatile to be a currency. This is, to be clear, a terrible argument. People often make the point that Bitcoin is volatile and conclude from it that Bitcoin is useless. Because it's volatile, it can't be a currency and therefore is useless. Now, there are two bad steps in this argument. First, bad currency now doesn't mean bad currency forever. They're making a prediction about the future, which may or may not be founded, typically not. And bad as a currency forever doesn't mean useless. There may be other monetary uses that go beyond being a simple medium of exchange, for example. So this is just a lazy argument, and it is not the one that I'm raising here when suggesting that there's a transition problem. My question is rather, can Bitcoin's notorious volatility be tamed to make it more useful for more people in more ways? Clearly it is useful for some people and in some ways. And my question is whether it can grow along any of those three dimensions. We can state the problem a little bit more exactly. Here are the parameters. Can Bitcoin achieve something like price stability with respect to consumer goods, let's say? So don't worry about the US dollar, don't worry about the Swiss franc, worry about the goods that you want more of. Can it do that without protocol changes? And I submit that protocol changes that involve supply are hopeless. This thing is effectively ossified, and supply will remain wildly inelastic. So the question we're asking now, the parameters require us to think of solutions that involve stable demand. When price is a function not of supply and demand, but demand only, stability can come only from stable demand. So here's an open question. What variables best predict demand for Bitcoin, and are they likely to stabilize? Are there perhaps historical examples to draw from? Think here of the transition in, let's say, Amazon, from being a highly speculative stock to something closer to a blue chip. The demand curve changed. The mental model people had of this asset changed over time, and so the way they traded, the way they bought and sold and held it changed over time as well. Could this happen to BTC? It's an open question. I'm not going to answer it, but I will raise a few speculative thoughts that figure into an answer of that question. What we're really thinking here about is whether speculative demand can transform into something more stable. We're asking, can another kind of alchemy occur, another kind of transmutation? And just a caveat, the distinction here between speculative demand and, let's say, fundamental demand is not nearly as clear-cut as many imagine. And looking at the history of famous so-called bubbles gives us insight here. I've cited an essay that I highly recommend to anyone interested in thinking about that question. But let's say that there is a distinction. Here are three aspects of speculative demand, and these are spectra. They aren't binaries. On the one hand, we have pure Keynesian beauty contest. This is where you decide to price an asset based on how you think others will price it. So this is purely reflexive. Imagine the judge on a beauty contest looking to see what the other judges are going to do and trying to guess. So that's one end of this particular dimension. The other end is pure fundamentals. When you ignore the crowd, just look at the fundamentals, whatever they may be for that asset. In this case, they would be endogenous variables within the network, among others. And then make your trade accordingly. Well, here's another aspect of speculative versus non-speculative demand. The time horizon. Are you making a short-term trade? Are you trading on 5-minute candles? Or are you looking at long-term trading, where you trade the 1 year or the 5-year candle? Third, a risk-on strategy versus a risk management or even risk-off strategy. Now here's a very bad argument. Some of you will remember this from, let's say, 2015, back when it might have sounded a little bit smart. Oh, BTC isn't scarce because they'll clone Bitcoin. I guess that's my no-coiner voice. Now, this is a silly argument, and we know why. Nothing else can offer all of Bitcoin's fundamentals, settlement assurances, network effects, and so on. And demand that's informed by those fundamentals discriminates sharply between BTC and other crypto assets. Purely speculative demand, by contrast, need not. So set aside that very bad argument and consider now this more interesting argument. Could it be that proliferation of crypto assets provides supply elasticity that matches this speculative demand, a stabilizing force for the crypto space as a whole? That is, could the rise of things that aren't Bitcoin function in a way as elastic supply of the thing wanted, which is a volatile speculative asset to play around with, to buy and to sell? So here's a scenario to consider. There's all this purely speculative liquidity that has flown into Bitcoin. Might it exit for new opportunities, leaving behind non-speculative demand? Well, and not just leaving behind, but in fact being replaced with new non-speculative demand as it steps up to the plate. And the kind of demand to think about here especially is demand tethered to risk management or allocation mandates. And that should remind you of one thing: institutions. Institutions that have a mandate to, let's say, keep a portfolio allocation 5% max to Bitcoin. Well, as the Bitcoin price goes up, they'll have to sell a little bit. But of course, as the Bitcoin price goes down, they'll have to buy a little bit. Or a mandate that's tied to risk. So the rise of non-speculative demand replacing speculative demand as it exits for other more volatile, crazier assets could be a mechanism by which the demand curve for Bitcoin itself becomes more stable, and thus the price becomes more stable. I'm not saying that this is happening definitively or that it will happen, but it's an interesting scenario to think through and one certainly to watch for. And Nick Carter has said some very interesting things about this on Twitter of late. So is this happening at scale? I would say so far the answer is not no, and it might be yes, that is, institutions. And on-chain metrics are helpful here in figuring out what's happening as it's happening. And one should here look to Willy Woo on Twitter for guidance. A superb resource for on-chain metrics. It's time to draw some conclusions. That thing you hear about in the headlines, Bitcoin's price, it does indeed bear a systematic relationship to the protocol itself. And the story of that price is the story of freedom technology at scale. I like to think that somehow, somewhere, a cypherpunk is smiling down on all of this. A number of people have helped me think through the ideas for this talk. So for questions, comments, feedback, inspiration, objections, and more, I thank, of course, and first, Bradley and Craig, my friend TC, the Middlesex University's Computer Science Colloquium, which was kind enough to listen to me give a version of this and provide generous feedback, and all of Bitcoin Twitter, especially Gladstein and Nick Carter. You should follow them, and me, and Bradley and Craig on Twitter. Here are the sources that I've cited. If you needed PDFs for any of them, email me. Cheers, y'all.